Hello, how are you? Today we are looking at bad debts. You know what happens is it's not always that businesses actually do their activities on a cash basis. Sometimes businesses actually do operate and sell on credit. They sell on credit. And in such scenarios, it is actually impossible that all the amounts for goods sold on credit can be actually recovered. So this means that it is actually possible that businesses can actually have what we call irrecoverable debts. Can have what we call irrecoverable what debts. Irrecoverable debts are also called bad debts. They're also called bad debts. It's very important for you to know about them. Uh, what are bad debts? These are amounts that remain unpaid at the end of a given period. We are so sure that we have tried by all means and these amounts cannot be recovered. So they are called bad debts. And sometimes it's also possible that an amount that you could have written off as bad debt can be recovered. Probably the customer's business has started operating better and the customer is able to pay the amount. That one is called a bad debt recovered. Okay. Also, as part of the prudence principle, we have to create what we call a provision for doubtful debts, whereby we set aside an amount to cater for irrecoverable debts or bad debts. That is called the provision for doubtful debts. We can even create an account to show if there's an increase or a decrease in such provision. We'll talk about that. So, to deal with bad debts, once you actually see that a debt is now a bad debt, the thing to do is you credit the customer's account and you debit the bad debts account. Okay, you're going to see like in this case that we have here for a paper that from a paper that is from 2018, it says that on 31 August 2018, Adil received a check for 20 cents in a dollar from Mahinda, a credit customer. The balance from the account was irrecoverable. Record this information in the following account in Adil's ledger. Close the accounts on 31 August 2018 by balancing or making a transfer to an appropriate account. Some entries have already been made for you. So if you look at this Mahinda account, it shows us that as at 2018 February 1, this customer owed us 600, but he retained some goods to us worth how much? 30. Okay, which means that if you're going to see the customer now owes us how much? 570, right? But we are told that this customer paid us by check 20 cents for every dollar that the customer what owed. So from the 570, he paid us 20 cents for every dollar. So if you're going to multiply 20 cents, um, 0.2 times 570, you see that the customer paid us 114, right? And our account will balance with 600, 600. Then the balancing figure there is how much we are owed, which is 456. So this amount has been transferred to bad debts. As you can see what I did for you here, we just write bad what? Debts 456. Okay. So we have credited the customer with the amount that he owes us. So this particular 456 now has to be transferred to the bad debts what? Account. So you can see that the customer actually balance comes down here as Mahinda 456 on the debit side. Why? Because remember I told you that when you actually write off a bad debt, you credit the customer's account like what they've done with Mahinda's account, and you debit the bad debts account. So we have debited this account with 400 what? 56. But you can see that we actually had other debts that we had what written off worth 710. So which means that now the total that we have that has been written off is 1,166, right? So this whole amount, that 1,166, is transferred to our income statement now as 1,166 at the end of the what? At the end of the year. So that is how much goes to our income statement. That is your bad debts account. It is debited with all amounts that have been written off, and we credit the total that is transferred to the what? To the income statement, as we have just done here. Which means even if they are going to say create a provision, create an extract of the income statement, we are simply going to say Gross profit less what? Expenses. Which expenses? Bad debts. 1,100 and what? 66. So bad debts are an expense in the income statement. So follow in the next video that we're going to be doing, where we're going to be talking about provision for doubtful debts. Thank you.